Mr. Pramod Rajani is an experienced investor and founder of an investment firm with comprehensive view of global investment landscape. He is a qualified chartered accountant, FCCA, and has spent his career as an investment professional prior to incorporating his own investment firm. Through his career, he has extensively managed and advised investments across major investment markets in the US, Europe, Asia. He has worked with Honeywell, Chrysler, Values, and Arthur Anderson. Mr. Pramod Rajani was
Okay, thank you, everyone. Thank you for the lovely introduction. I'm not quite sure if you can see and hear me. If perhaps one of the organizers could just quickly drop me a chat, see that I'm being audible and that I'm visible to the audience there. I just wait for a quick confirmation. So can anyone see me and hear me? I'm just waiting for a quick confirmation before I start the session. Okay, great, fantastic. Right, so thank you very much for the lovely introduction, and thank you to the college and the NCC as well for having me over here. I appreciate all of you organizing this event, and I hope that the cadets that are there, that they kind of can learn something from this, take away something from this, and I hope they've enjoyed their session so far. What I would perhaps like to do, I understand that we've probably got a broad spectrum of participants here. I understand there'll be some folks from the first year to the third year in the undergraduate. We may also have some postgraduate students who may see this online, I understand. So, I'm going to try and keep this as relevant to everyone as far as possible. So the way this will work is I'll make a presentation. If you've obviously got any questions, if it's something you think is very urgent, just please raise your hand. But if you think that it's a question, I'd sort of keep a slot towards the end for all Q&A. And if you've got any questions, I'll be happy to address them there. So I'm going to share a presentation, and then we can walk through that. But just to sort of give you a quick background here. So I'm going to be running a presentation on careers in financial services or the financial sector. The sector essentially is, it's a very widely followed sector, and it's very popular amongst most graduates and students in India because everyone basically who you know in India or who's been a commerce graduate for the last 30, 40 years has either pursued a chartered accountancy or has been an aspirational pursuer of financial services as a career. And as many of you may know, you may actually as many of you know, you may actually get you've probably heard of many of these engineers who tend to go to the IITs, and then they do the engineering, mechanical, electrical, whatever it is, and then they go to the IIMs. And then ironically, they spend all their time in their career, in their academic career, sort of learning about science. And then after that, learn about management, and then just, hope to sort of get into a bank or some sort of a financial institution that is very lucrative and rewarding. But nonetheless, it's a very popular sector. So I'm here to discuss a lot of these things. If you've got any questions, please let me know and we can start that. So with that said, I'm going to start the presentation. I will request one of the organizers and hosts, perhaps, as if and when questions do flow in, to please perhaps assimilate them, organize, get it together, and then we can go through them one by one. Okay, so with that, let us start with this. I'm assuming you can hear me. Everybody here can hear and see the screen. If you can, that's great. Otherwise, I'm just assuming you will sort of hear it. So we're going to talk a little bit about finance, and I got straight into it. What is finance? Finance literally is actually just another name for money. And this sort of originated going back to about a few hundred years ago, when you actually had currencies and money that was initiated and started and printed. So the very first finance kind of role, if you will, was buying and selling or exchanging a commodity or a transaction, and currency was used for that. And with time, things have sort of evolved and expanded, and in the last 100 years or so, you basically had a significant expansion in the types and capacities of roles that exist in finance today. You have so many ways in which money is managed, advised on, invested, spent, that there's a vast expanse of roles that exist in this sort of world today. So, just talking a little bit about finance, you have to understand that what is it about finance what are the skills that you sort of need in finance to succeed? So, analytical skills are required in every role these days, but it's all the more relevant in finance. There's a vast range of skills that have kind of emerged, evolved, and you sort of need to adapt and understand to be able to succeed over the long term in a career in finance. And so you've got to be able to understand that the nature of all types of work in finance, even though you've gone from buying and selling products to sort of having sophisticated instruments that are there these days to be able to participate in capital markets. At the end of the day, really, finance comes down to just three basic attributes. And you have to sort of understand that all finance careers come down to three buckets. The first bucket, which many of the commerce students here will be very, very familiar with, is called capturing and reporting money flows accurately. So this money flows obviously in the global economy. We all know that. But the point here is, so this is where the accountants, the auditors, the tax experts, they come in. They sort of are involved in the process of capturing and reporting the money flows accurately. The second big sort of activity or nature of finance role that exists in the world today is basically deciding where the money flows. And when I say decide where the money flows, in a sense, you basically take ownership of the money that you possess, either for yourself or on behalf, or you're a custodian for somebody else. You're acting on behalf of other people's money, and you basically decide where the money flow, whether you should invest it, you should take it out, you should lend it, you should borrow it. As the term is appropriate, that's what gets done. And then the last bucket, that's there is really that the advising on how money flows and assessing risk, or essentially, you kind of facilitate a very smooth money management process. This is where the advisory and service-oriented roles come in. You basically advise on where money should be managed, where it should be invested, or you figure out a way on how to basically make the flow of money or management of money easier and faster or more cheaper for those who are actually handling and managing the money. So this is basically kind of like, no matter how complex and how sophisticated finance has evolved, this is exactly what is going to be, this will be the framework for the future always in finance. So even though the term is financial services, you have to understand that the second bucket, which I spoke of, deciding where the money flows, is more of money is your trade there. Money is your product. I mean, you decide then basically, where you put it in, where you take it out. So the term financial services is a very broad term, but you also have to understand that the actual management of money is a bit more different than being a service. So now that you have a backdrop of what finance is and what kind of skills or what kind of activities there in finance, you're probably wondering, as most of you are students and graduates, what are the skills that would be required to succeed in these roles? Now, to start off with, I'd probably say that the very first thing, no matter what you do, which line of finance you choose, these following three traits are an absolute prerequisite. And I say it's a prerequisite because if you don't have them, or if you don't enjoy them, you may not have them. It's perfectly fine since you're just graduating. You may not have them at this point. A lot of skills are developed and acquired. but it's absolutely important that you have an interest in these skills. If you have an interest, or you're fascinated, or you enjoy these things, the idea of it as well, then the odds are that you can actually make a good sustainable career, and a sort of a successful career in finance. So the very first thing is you've got to be analytical. Now, the term analyst these days is used very, very widely. You've got an operations analyst, you've got a technology analyst, you've got analysts in every sphere, in every industry, in every walk of life. And that doesn't actually mean that everyone necessarily is analyzing. Unfortunately, the term is a little abused, if you will, in today's corporate environment, where people just kind of use the word analyst for anything and everything. So an analyst obviously does a lot of things. Even someone who's kind of just running a few things which are automated, they also tend to be referred to as analysts. So I want to make that distinction, that when I say analytical, I mean you've got to be able to actually think about understanding the context. Analytical essentially means understanding the context, understanding the backdrop, making sense of a situation, making sense of the numbers that are presented to you, making sense of the environment, valuation, whatever you want to look at it. You've got to be able to. Analytical essentially is sort of the ultimate goal of being analytical is sort of trying to get a comprehensive view, complete picture, and then coming to a logical, sensible, likely conclusion, and getting the inference and takeaway for that. So that's essentially, if you enjoy being analytical, then that's one of the skills that are required. The other thing, if you're in finance, you've got to be able to enjoy working with numbers. And that doesn't mean you need to understand advanced calculus and things like that. No, you don't need to go to that extent, but you've got to be, familiar and comfortable with numbers. If you've enjoyed numbers in different capacities, then, finance is something that you can easily sort of blend in with. And then the last thing really is that no matter what kind of finance profession you take, although there are some roles which are a bit of an exception, you've got to be aware of basic financial statements, how they interlink with each other, and basic financial terms, concepts, and conventions that are there. And that's absolutely essential because no matter what kind of field you're in, inevitably everything will boil down to a lot of the terms of money management, which will come down to these statements and these concepts. So you've got to be familiar and aware of this. You don't necessarily need to specialize in it depending on the career path you choose, but you do need to be aware of this. If somebody tells you, what is enterprise value to EBITDA, then you've got to be aware. You might not necessarily understand the absolute details of the calculations and how it's been arrived at over there, but you've got to be aware of what it means, what it presents, and just that's going to sort of help you sort of remain successful and sustainable in your career. So those are your basic skills. Besides that, you've also got those are your core skills that are absolutely required. And then besides that, you will need, as most of you know, finance as a sector, financial services, the industry has evolved a lot in the last sort of couple of decades. So there's a multifaceted skill set that's required for a lot of these profiles. Even the conventional mainstream profiles, which were there 30 years ago, they have been re-engineered, they've been reborn, and there are new things you need to do to sort of stay relevant over there. So some of the things that you will absolutely need today to sort of succeed. This is something that's perhaps not as well discussed in career graduate. I don't know if any of you have been to career graduate seminars, but to be able to succeed in finance, no matter what the profile is, you have to be able to get a sense, you have to be able to estimate risk, and you have to be able to estimate reward. Those who succeed in the long term in finance, irrespective, we'll get into the types of work that go on, but those who succeed with the types of, in finance, irrespective of the type of work, inevitably tend to be the greatest judges of risk and reward. And the better the judge you are of risk and reward, no matter what profile you are, the more likely, the high likelihood that you will succeed in that. And then the other thing which is there, no matter what you do in financial services, client servicing is an absolute essential part of it. Because at the end of the day, you're either managing your money or managing someone else's money, or you're assisting someone in managing their money. So client servicing, while it's important in many industries, in financial services, it is an extremely vital component because it's a very competitive industry. At the end of the day, fees, numbers are all there in place. And, obviously, if you bring clients, reputation, performance, all that is fine. But, if everything is standardized, which as many of you graduate and if you do sort of see in the financial service sector how it is, it's very cutthroat. The margins that are there that differentiate a Goldman Sachs from a Citigroup or a JP Morgan is not as much. So what sort of will determine how many clients or how your business is sort of stay relevant is your ability to service and maintain relationships with clients. And you'll find that this industry, client relationships are very, very important. And then in some roles, there's got to be awareness of extremely technical matters. Let's say if you want to become an actuary, an accountant, you do need to have a very specialized skill set for that to be able to succeed in that. And then lastly, I think in today's day and age, you've seen automation take place in many, many spheres, many walks, many careers that are there in many industries, right? From manufacturing to production to even sales. Finance is no different. So you do have to have, if you want to succeed in the future, you've got to have the ability to sort of, be abreast, stay adept with technological innovations and changing modern industries. Many of you will know, for example, you do now have, ride sharing. Ride sharing is a very simple thing which everybody can relate to, Ubers and such things. But some of you may or may not know that there are industries that are changing. 30 years back, oil was the big sort of global industry that was there. Today, it's technology. And then the way technology is changing also so fast. I mean, a lot of you may know how telecom, everyone has a mobile phone, I'm sure. So you probably are familiar with the basic fact that mobile phones these days run the technology connecting to signals from the towers that are there locally in these regions. Very soon in the near future, you've got companies like Apple and Tesla that have already done this. They're migrating to what's known as 5G. And this 5G essentially is going to perhaps be done in a different mechanism. You're not going to have towers. You will get the signals straight from satellites. They're going to launch satellites all over the stratosphere on Earth so that the markets in which they service it, you will have extremely strong signals on your phone, extremely strong Wi-Fi, internet. You won't have call drops, which I'm sure many of you will be happy with. You won't have slow internet speeds. So a lot of these things are changing. And so you are going to need to sort of stay adept and keep track and stay in tune with a lot of these changes. So before we actually get into the kind of financial roles, it's important, I think, since many of you here, I know when I was in college, this thing was not clear to me. And I know that perhaps there are many students, some of you might know this, which is great, but some of you, there are many perhaps who might not be familiar with how the modern, this is from an India perspective, but this is sort of broadly the framework that exists in the world today. Now, this is how money flows in our country, in our environment, in our economy, whatever you want to call it. You've got the government. So just a few footnotes just up front. Green arrows here represent a bilateral flow of a commercial relationship. Red arrows is a one-way flow. And the blue arrows are where there is an investment that takes place. So this is how money flows broadly in our economy and anywhere in the world. And it's important before you do consider a career in financial services, that you understand exactly how money flows in the economy. Very basic things, which obviously many of you will know, but hopefully this will, at least on the economy side, you've got the government. The government buys products and services from companies and industries. And these companies and industries in return also pay taxes to the government. The companies and industries pay employees their salaries, and the public in general, basically, they buy products and services from these companies. And employees obviously come from the public. And because there were some space constraints, companies and industries obviously buy and sell products from each other. And I think everybody here knows that every single person who's working and earns some money pays taxes. So that doesn't get depicted here, but that base case is there. But now, what about the financial services system? What about the financial ecosystem? What is there, and how does that sort of fit in? Now, I'm not going to talk about your accounting, auditing. Many of you are familiar with what they do, what happens there, and I can obviously discuss that in questions, but I don't need to necessarily represent that over here. We can discuss that later. But what about a financial ecosystem? You've essentially got banks, you've got insurance companies, you've got the employees provident fund, and you've got asset management companies, which I've bracketed as mutual funds right here. So what do these companies do, or what do these institutions actually do? Now, a bank, essentially, so on the left side, you've seen that's exactly how, call it in a very simplistic thing, the trade system works. You've got the government, you've got the industry, and you've got the public at large. You've seen the flow of products and services, the way it's bought and the way taxes are paid, the way employees get their salaries. Now, how do these financial institutions link into this? So you've got banks. Now, banks, they lend and receive money from all three of these stakeholders: the government, the industry, and the public. Again, when I say industry, I mean all companies in all industries. So I'm referring to that as a broad group. So they lend and receive money from all these three stakeholders, which is why you see the three green arrows there. There's a bilateral, there's a two-way commercial relationship that exists with all three. Now, banks, how do they, some of you may not know, but the banks also actually lend money to the government. If some of you are familiar with what a bond is and what government bonds are, the government from time to time issues bonds, they borrow money from the public, and banks and a number of these other financial institutions are the largest lenders to the government, at least up until now, since the history of independent India and since post 1992. These are the institutions that have been the largest lenders to the government, because the government has very rarely borrowed from overseas. So the banks have a relationship with all three both ways. They borrow from, when I say borrow, they receive deposits. So if you receive a deposit from either the general public or the company, it is a repayment, an obligation. They have to invest it to be able to repay that. And they also lend to all three entities in different ways. Then you basically got your insurance companies. Now, what do insurance companies do? They essentially receive money to provide insurance against your life, against health insurance, medical insurance, your property. You buy a vehicular insurance, your business, to ensure continuity of that business. So insurance, many of you will know, but for those who may or may be in different streams, insurance is basically providing coverage or making good a loss that takes place in the event of an unforeseen event. It could be a calamity, it could be an event for various reasons. So the insurer will reimburse the insured for something that actually gets damaged, lost, dies, or in whatever way that is. So they receive these premiums from the public or from companies. And essentially what they do then is, and you'll see the red arrows here represent the flows, the money flows are there from the companies, industry, and the public. They actually make those flows, those premiums to the insurance companies. Now, all these premiums that these insurance companies receive, that's actually money they've got to manage. So they have to make sure that they receive that and will obviously invest that in a place so that in case an insurance obligation does arise, in case they do have to make that payment in future, then they obviously should have enough money to make that payment that's there. So in order to be able to meet that potential payment that they may have to make in future, they will have to invest that money somewhere. So they invest that money in financial securities to ensure any potential insurance claims or liabilities can be met. And by investing it, it will grow, and therefore they'll have enough of a base or a corpus to be able to make payments for that. Now, Employees Provident Fund. I'm guessing some of you may know, may not know. I don't know this. I know that you may have obviously gone through your college. You may not even be in that year yet where you know what a PF deduction is. But the point is, employees, basically any employee, it's a mandate for the government of India where if you're working in a company, a part of your salary is allocated. You have a choice. But broadly speaking, I won't get into the nitty-gritties of this, but a certain percent, a small percent, say call it 8-10% of your salary that is there, gets actually contributed towards a provident fund. Call it like your pension. It's sort of a pension fund that's there. It's kept as a saving that's kept aside for many years. You can withdraw it at some point in the future as well. But the idea is to sort of keep some savings aside, which will be grown at an annualized rate that's communicated by the government or the EPFO every single year, at what rate that's going to sort of give you that return. And then you can sort of withdraw that. And when you do withdraw all that money at whatever point in the future, either when you finish working or you're between jobs, or you need money sometime in between after you work for a certain amount of time, or you've retired, at whatever point you can withdraw that money, which will be given. So let's say you've given 10,000 a year each year, and they're giving you an 8% interest rate. You get 8% each year compounded for those several years that it's there. So they clearly need to repay you at 8% annualized. So they're going to need to make these investments as well in securities so that they can make these repayments that are there. And so that is essentially what an EPFO, it's also the pension fund in India. Now, overseas, you've got private pension funds that have existed. I'm not going to get into that, but this is broadly the concept of a pension. This is the concept of this is a pension. It's called the EPFO. So this is India's only primary pension fund, if you will, that's recognized for all employers. And then the last bucket or last type of major financial institution that's there really is your asset managers, which are your mutual funds. Now, how is a mutual fund different from these guys? They also receive money from the public, but the difference here is the public actually makes. Now in EPF it's more or less mandatory, but in a mutual fund it's voluntary. The people like you and me or the average citizen actually contribute some money into a mutual fund. And a mutual fund, for those of you who may not be aware of what it is, you've heard of these funds like Nippon India Equity Growth Fund and things like that. So what it does is it takes money from the public that actually contributes, that can be in several thousand crores, and they invest that in securities. It could be stocks, it could be bonds, it could be commodities, with the hope that basically it's going to grow the wealth of those who contribute that. So that's the thing here. The money that's been received it's been received with the intention to actually grow their wealth more so than others. In your employee provident fund, you're going to get a fixed rate, and with insurance companies, if you're making a premium, that the only thing you're going to get, you're not actually doing that to build wealth. You're basically doing that to insure yourself in the event of an unforeseen calamity. And in that sort of event, if that does happen, you have this thing to fall back on. So these are not technically wealth creators from the individual's perspective, but for the companies that receive it, they've got to manage it. So for mutual funds, they basically have to do that to provide returns. It's not a fixed return. They're trying to do it as much as possible. So this is sort of the financial ecosystem that exists in India and broadly that exists in the world today. So now, having said that, we'll go to the types of financial services activities, financial roles that exist in the first bucket, which we said, of all financial activities. And that's basically capturing and reporting money flows. So this in India has been the most widely followed career route for graduates over the last several years. You have had you've had accountants, auditors, tax consultants that come here, and what they do essentially is accounting is basically it's called financial reporting. You prepare books. You're involved in the process of preparing the company's books. It's done online these days. You don't actually write it in a book anymore, so it's done in systems that are there. You capture that. You prepare. It's all involved in preparing the financial statements. The auditors, in turn, will review the company's financial statements. They will certify that it looks okay and that it's in line with the generally accepted accounting practices or principles of that region. And then you've got, the tax consultants who will also sort of look at and assess that the taxes have been calculated accurately and been done that way. So these are basically the accountants, auditors, and tax consultants. These are the guys who get involved in this. Now, historically, many people have actually thought that this is the only career that's been available to people in finance in India for the last, say, 30 years or so. Now, that was true quite some time back, but in today's day and age, that's changed a lot. There's a wider variety of finance roles that have been created in India. As many of you might be aware, you've had companies that have actually invested in India. They've set up offices here. You've got your big four consulting firms that have set up global offices here. Even your overseas financial institutions, your Templetons, your Fidelities, and JP Morgans, they've all got large offices here in India that actually work with global teams. So there's a very large sort of set of operations and regions that are serviced from India, in addition to India in itself. And so that's why you have a very wide variety of finance roles that have been created today. But I will get to those in a minute. But just to kind of wrap up on this sort of profile here, you basically have, the main sort of professional qualifications to pursue here are chartered accounting, cost and works accounts. But, in recent times, you've had more popular, globally recognized qualifications that are more relevant in the context of the global framework where, you've got the international reporting standards that are there. They're aligned and attuned with the international requirements, and therefore a lot of students, a lot of graduates have actually pursued this over the years, and they're doing that. So organized qualifications such as the CIMA or the ACCA, these qualifications are sought after by both employers and employees in India and overseas as well. Now, the second bucket of things that are there, the mainstream finance jobs, they actually lie over here, which is deciding where money flows. Now, if you've got to decide this is where your conventional old school finance actually originated and still remains. It still is where a large part of the jobs are and where money is managed. So this to succeed in this type of work, if you decide where money flows, you're essentially an owner of, or you're acting as an owner of the money that's being managed. You're either receiving it or investing it. So in this case over here, to succeed in this type, the skill that's probably the most relevant, in addition to your core skills which I discussed above, you're going to absolutely have, and you'll acquire this with time. It's not something that you get right away. Nobody gets it right away unless you're born. You start early, like perhaps a Warren Buffett, who started when he was 10 years old. That's a little absurd. But the point here is you have got to be able to estimate risk and reward. And the better you are at it, the more successful you will be in this line of work. So just to sort of talk about some of the profiles here, you've got commercial banking. Banks essentially decide who they lend money to, whether it's a company, industry, someone, people that's there. So from a bank's perspective, what they obviously look at is, the risk profile of whoever they're lending it to. If a bank basically is more concerned with ensuring protection of capital and safety of capital. So one of their biggest conditions to be met when they decide who to lend to, obviously, is the risk profile low. They obviously have the least risk tolerance of all financial institutions. And therefore, they consider the risk of the borrower profile and before they decide where to invest that. So banks, obviously, as many of you know, they receive deposits. Now, the deposits they receive are their liabilities. And the loans they make, or they lend to or invest in the form of loans or bonds with the government or companies, to whichever they subscribe to, those are their investments from the bank's perspective. So they obviously look to sort of receive that, manage it together, and manage getting investments, obviously, more than how much they need to repay them. The other kind of work that goes on here really is, investment banking. You've got perhaps many of you have heard of names like, your JP Morgan, Goldman Sachs, and so on and so forth. So these are your investment banks. They also have commercial banking operations, but they're more jazzily known for the investment banking arms. Now, what do they do? What is the core nature of an investment bank, which I don't know if it's still being taught in college these days. When I was there, this was called merchant banking, but it's called investment banking in today's day and age. So it's essentially raising capital for companies that need money, funding for various reasons, for funding their operations, to grow their businesses, to acquire an asset, to expand into an office in a different region, whatever, to repay debts, this capital is required on a large scale. So what an investment bank does is they connect these large financial institutions, your banks, your insurance companies, your provident funds who have large amounts of capital, and matching them to companies that require funding. And then, so these guys, the financial institutions, will decide if an IPO is coming up for a company. They'll decide, okay, look, does this company look like it's got a reasonable future, good, bright future? Should we invest some money into that? Or that's on the stock side. Or they may also do something where they do it on the bond side. Let's say if a company wants to borrow, about, say, 1,000 crore rupees, the bank or any of them will sort of look at it and say, okay, look, what's the credit profile of this, the credit risk worthiness that exists for this thing? We'll decide whether we should lend or should not lend, and at what rate you'd be looking to sort of receive that to justify the risk that you're taking that way. So this is what an investment banker does. They basically connect these dots and get this done. The other type here is your corporate finance. Now, corporate finance essentially is where these are teams that exist in companies, whichever company, in whichever industry that exists today. You've got corporate finance teams. What they do here is they work closely with the executive management teams to decide how much money is actually needed to fund their business, large scale, obviously. I'm not talking about necessarily day-to-day small amounts, but larger, bigger picture, how much money is needed in a year, how much capital is needed to fund their business, how they're going to fund that, where they should fund that from, at what rate, what sources, those kind of things. They look into that and decide, they work with management to decide how they should do that. A lot of them also actually are involved in the process of deciding whether or not they should invest, buy or sell certain assets like companies, whether it's another company to acquire it, taking it over, or buying an asset, selling an asset, or selling any of their subsidiary companies. So they work pretty closely with management to actually figure that out. So as you can see, the common theme here is all these teams here, they decide where money is flowing. They're deciding where to receive it from, how to receive it, or how to actually invest it or give it. So that's the core sense of this function. And then you've got asset management, which I've already discussed, insurance companies, PFs, mutual funds, they're all asset management companies. But I've already mentioned the distinction between those three, so I won't get there again. But they are asset management companies because they all manage assets of the public. The premiums they receive, the insurance premiums they receive, the contributions from employees' salaries, the mutual fund contributions or SIPs that they receive. This is all money they've received. These are assets that are being managed. And they invest in securities to ensure that the returns that they generate are in line with the objective and what's required there. And then you've got this last bucket of what I like to call sophisticated asset management companies. I call them sophisticated because they're not conventional. They don't necessarily go appeal to the masses, or they're not available to the masses at large, because what they do here is, your venture capital firms, your hedge funds, your PE firms, they also manage money and assets of some extremely wealthy individuals who contribute, say a minimum chunk. Maybe I'm making this up. Let's say 50 crores. Give them 50 crores, manage it. Now that they pool, let's say, maybe 2,000 crores or something. Their fund size may not be anywhere near as large as any of these mutual funds or pension funds or insurance companies. But what they do, what distinguishes them, is they tend to have a track record of generating higher returns. So they basically invest it, but they're more aggressive investors. They find different ways, different places to invest. And because of that track record, there's inherently higher risk, but they do charge higher fees for generating that higher level of return. So that's sort of the framework of what exists in this conventional system. And then the last type that's there really is the advising on matters related to money, which is the third bucket of which I discussed. So this type of work essentially advises people who manage the money, and they facilitate or they help in the management of this money. They make it easier, either more cost efficient. They advise in different capacities, and then so the key attribute here to succeed in this, risk reward is estimating it is important in all lines of finance, but there's a greater emphasis here to sort of manage and control, identify and manage and minimize the risk, whether it's a process, whether it's the money, whether it is the risk profile of the investment that you make or the service you're recommending. It is about controlling and minimizing risk. So some of the types of work that go on here are, you've got investment banking. Now, investment banks, we did discuss them in the deciding where money flows, but they also do have the capacity where they're advising, they're acting as advisors. They have teams that advise companies on M&A, which many of you may have heard of. They advise companies on whether they should merge or acquire another company, or on the flip side, sell one of its subsidiaries, one of its own companies. And then if they are going to do that, at what price, at what value should they do that, buy or sell? So they actually get involved, they negotiate with companies, the other companies that are being discussed over here, and they actually negotiate and handle the whole process of that, right from start to finish. They also have research teams, essentially, that they research financial securities, stocks, bonds, currencies, the entire gamut of what's available that's there, which advise these asset management companies who decide where to put the money on where they should ideally put that, and where these research teams think that offer the best risk and reward, or rather the least risk and most reward, which we call in the financial services industry the best risk reward, which meaning the greatest possible reward with the least amount of risk in that profile. And then lastly, they also execute trades. For a lot of these asset management companies, you've got traders. I'm sure you've heard of sales and traders of these desks. They basically handle the relationships and they execute whatever orders that asset management companies. These guys may say, I want to buy 1 million shares of Reliance Industries. So these investment bankers are the brokers. They're licensed, registered brokers, and they execute these shares on their behalf. So you can see over here, the common theme with this is they're not actually deciding where the money flows. They're providing advice in an advisory capacity in terms of assisting that. And then you've got a few other types here, which is financial consulting. Now, you've got consulting firms like your auditing firms and your strategy consulting firms that provide financial advisory services, like assessing if a company can cut costs in its business, figuring out how to actually make a way to make a particular segment or a department more cost efficient, finding if there is an easier way to sort of boost revenues, enhancing product mix strategy, things like that, which will actually boost some of these revenues of these companies or reduce costs or find an optimized way that way. So these are what we call financial advisory or financial strategy consulting. And a lot of these companies do that. And so they also advise many of these companies. Now, the banks involve they basically advise on the larger capital company acquisitions. But some of the smaller things like whether to buy real estate, whether to buy land or property or things like that. You've got specialized consulting firms. You've heard of these real estate brokerage firms, JLL, CBRE. These guys actually get involved in the process of advising on whether or not they should acquire or sell a particular piece of property or land, whatever it is, and if they are, what price. So, and they also do this for assets. And then the last couple of things that are there over here, which broadly bucket the whole thing that's there really is, you've got your financial planners. Now, financial planners are essentially people who are wealth managers. And what they do is they advise, typically, not everybody, and I'm sure many of you don't necessarily go to a financial planner, but in India, historically, financial planners have catered to what we call high net worth individuals or, ultra high net worth individuals. These guys have a lot and they need to figure out how to go about managing their wealth. These individuals also are families in India. Think of your Birlas, your Ambanis. They may or may not have family planners, financial planners, sorry. But they definitely, anyone who tends to have a lot of wealth does need to have an active strategy to manage that and sort of to preserve that and grow that with time. And so therefore, a lot of these financial planners, they tend to advise individuals as well. It can be someone who has, 2 crores, 5 crores, whatever it is, and how to go about managing that. And they will understand the objective, the financial goals of a lot of these individual people or these groups, and design a plan for them in terms of where they should manage, park their money, invest it, park their money, and grow it over a period of time. In case, a family might say, listen, I want to grow my wealth 5% a year for the next 20 years. Accordingly, they will customize a plan where they can put it that way. Put, let's say, 30% of their money in stocks, 50% in government bonds, 20% in gold. That's just an example. So that's what they do. And then these are all your conventional streams of financial services profiles. But there's this last type, which has emerged in the last sort of 5-7 years, which is financial technology. Many of you may know of this or have heard of this as fintech. Now, what is fintech? Fintech is basically any company that attempts to change the way conventional financial services activities are done using technology. So that's a pretty broad scope. So what people like to call it is disruption. I don't look at it that way. I think, it's just changing the way things are being done. It's a wide term. Anything that looks to does this is called fintech. And some examples that basically, many of you may have heard, I'm sure everyone has heard of cryptocurrency, and the news, it's been there in the news lately when you've heard of Bitcoin going ridiculously high. So if you're all familiar with cryptocurrency, which you will at least at a notional level, I'm not going to discuss that, but you've got things like cryptocurrency, which is an alternate way of accepting payments. The key feature of cryptocurrency is there is security, greater security in exchange of transaction. Instead of money, you're using cryptocurrency to do that. And then there are other things like, you have apps that basically allow you to check your creditworthiness if you can apply for a loan. If you can, you get it then right away. So it just simplifies. Anything that comes under this stream gets classified as fintech. And you also have things like, risk management and things like that. And now you've got basically, these are the kinds of typical roles that I've laid out, which typically are available to most young employees, fresh graduates, young graduates who sort of look at these kind of roles in the first, say, 3 to 5 years of their life. Now you can see here, it's pretty self-explanatory. An investment banking analyst, someone who works in the investment banking activities, either you're raising capital or you're advising companies, you're assisting in raising capital, you're advising companies on whether to do an M&A, you are either any of these financial advisory things that are there. A research analyst, an equity research analyst, this is what I was talking about. You advise, you make recommendations on stocks. Equity is obviously for stocks, but you'll also have a credit research, which is for bonds. And then you'll have a commodity research, things like that. You'll have different things. An investment analyst is someone who is an analyst who works with, let's say, Nippon India Life. They help decide where to invest that money they've received as a mutual fund. A corporate finance analyst, they work with the corporate finance teams. You've got loan officers, underwriters, insurance underwriters. These are guys who work at insurance companies, at banks. a financial analyst or consultant. Now, the consultant basically can work in the consulting capacity, which I said, and then accountants, auditors, you guys are familiar with that. There's this one function that I do want to sort of touch upon a little bit. It's an actuary. I don't know if many of you are familiar with what an actuary does, but so one of the things which, as we discuss insurance companies and pension funds here being the Provident Fund, how do they know how much they should basically invest, how much money they should actually hope to receive, or rather how much they will need to be able to make a payment in future? If I'm an insurance company, I say the premium is 10,000 rupees. Now, how am I going to know if 10,000 rupees is the right value to cover for insuring something which is, say, 2 lakhs or 3 lakhs? I won't know that until I actually assess the risk that goes on behind that. So an actuary is someone that works at these companies, and what they do is they estimate risk. They assess risk that is there here. They assess risk. So for example, if I'm an actuary at an insurance company, I'm going to look to assess the risk of the broader demographic profile of the public at large. If I'm in Chennai, what is the life expectancy of the average adult in Chennai, considering things like pollution, considering things like the advent of medical science, technology, income that's there, diet consumption, just things like that. And then using statistical ways to assess what they think roughly life expectancy will be. Someone could actually say, okay, I think life expectancy for those living in Chennai could be 80 years on average. And so therefore they work backwards. They say, okay, look, we will only have to make payments until on average the person is 80. So they'll price their thing accordingly. They'll estimate the risk that's there in terms of the lifespan of the insured. They'll figure out how it's done. They use maths and statistical techniques to do this. That's what an actuary does. An actuary gets qualified to do this. So accordingly, they help in the pricing of insurance premiums. So once you figure out the life, you figured out how much coverage you're going to give and how much money you should receive to get that coverage, you will then obviously therefore look to price your premiums accordingly over a period of time. So that's how it works there. And then you've got financial planners, traders, financial advisors, and so on. Now, what kind of qualifications are actually there to pursue in these roles are there? These are your major qualifications that actually exist in the world, in India today at least, in context of India. You've got the ACCA, which I discussed. That's a chartered accountancy, international chartered accountancy program. You've got the CFA. Now, the CFA is very, very prominent and relevant in most financial services roles. It's very widely used across the financial services field, but it's very relevant, especially if you are going to be in the active role of money management, whether you're an asset manager or you're a corporate finance person, but it's very, very relevant if you're going to do something in the money management space, which is deciding where to invest and so on. The chartered alternative investment analyst, again, is in the money management space. But here, what is an alternative investment? Alternative investment, for some of you who may not know this, is basically where, real estate and private equity funds and hedge funds, these are conventionally alternative investments. Your mainstream investment, this is just industry terminology. Your mainstream investments are, your equity, fixed income, and your currencies. So that's just how it's bucketed. Both have an overlap. The CAIA is just slightly if you want to specialize in real estate and things like that, whether to invest in that. The CIMA, the Chartered Institute of Management Accountants, these courses you guys are familiar with, the ICWA, the ICAI, the actuary, I just mentioned to you what it is, the Institute of Actuaries of India. You can become a certified financial planner, and you can also have financial risk management, FRM, which is also relevant in the industry. And so I'd like to wrap up with one very last slide here, which talks of, to sort of succeed in finance, regardless of the role you choose, you've got to basically have, finance and having business acumen, commercial acumen has always been a required trait to succeed. You won't succeed if you only have one of them. If you're good at finance, but you don't have a sense of, where to buy, where to sell in business, commercial sense, then your progression sort of becomes a lot more difficult. So to have both together, you've always succeeded that way. But going forward, there's a new skill that you will absolutely need to get. And that essentially, to be able to sort of, excuse me, so there's a new skill that you will need to be able to acquire. That is going to be critical to decide how successful you will be in the future. And that's basically your ability to adapt to technology and innovation, scientific innovation. Like I said, there are things now, you guys may have heard of how electric vehicles are coming. They're going to replace cars that are there. And what that means is that your conventional fuels industry, your oil and gas, the demand for oil and gas, going forward now is going to be dramatically less, because 75% of global demand of all fuels, of all oil and gas, goes towards transportation fuel, whether it's airlines or road transportation. So if 75% of that demand is gone, it's all replaced with electric vehicles. Electric vehicles run on different technologies, lithium-ion batteries, these kind of things. If you have a different thing, if you have a thing that's changing, you're going to need to stay updated. You need to understand the scientific changes that actually go on with a number of these things. And so if you really want to sort of thrive and succeed in the future, you're going to need to have all of them, all three of them. And with that, I'm going to sort of stop the presentation. And I will now hand it back over to the organizers to open it up for any Q&A or any questions or anything that they want. So I can't, I don't know if I will be able to see any comments or questions. So I'm going to leave it to the organizers to sort of let me know if there are any. Okay, great. So it seems like there are no questions. Fantastic. I can only take it that means that people either slept through it, or they knew everything, or somewhere in between. Maybe they enjoyed it and didn't have this thing that is there. So anyway, so thank you all for your time. I think with that, I will wrap it up.
It was an enlightening session. Now we'll have a short break. I request the audience to collect their